Jupiter Mines is the largest manganese miner listed on the Australian Stock Exchange, and we are that way because we're a large investor in one of the world's best manganese mines here in South Africa. It's a mine called Tshipi, and it's located in the Kalahari manganese field, where 70% of the world's manganese reserves are located. So Tshipi, top 5 producing mine pretty consistently on a global basis, more than 100 years of mine life remaining, and it's well positioned on the cost curve. And that means that the mine has produced very good dividends for its shareholders, notably us, Jupiter, throughout the cycle. And that's important because manganese prices in the last 6 months have been fairly low, and the mine is still producing positive cash, and that's a core part of the value proposition. As you'll see in this presentation, we have announced since I last spoke here a year ago a strategy for growth, but the strategy is focused on continuing our current dividend payment policy. Everyone likes the dividends that we've been able to pay over the last 5 years since we have been listed. And so we're continuing that dividend payment policy whilst growing in some focused areas, and I'll talk about that more in a moment. Neither Tshipi nor Jupiter have any debt, and so we have really a pure exposure to the manganese price with that low cost base, as I mentioned. And at today's share price for Jupiter, we have paid, as you can see there, 108% of our market cap in the last 5 years, notwithstanding the mine that has supported those dividends has more than 100 years of mine life remaining. So you'll see me making the rather obvious point at the end that we think the company is good value at these share prices given the demonstrated dividend payment track record and our policy to continue paying those dividends. We've got several large shareholders who are important to the implementation of the growth strategy that I'll be talking about in a moment. The largest is a broad-based black empowerment company here in South Africa called Instant Bentley Holdings. They're our largest shareholder at Jupiter. They're also our largest co-investor at the mine. Our next 2 largest shareholders are AMCI and POSCO. So we've got good strategic backing from well-positioned parties who have been there for a long time in Jupiter and can help in very practical ways with the implementation of our strategy. So you can see here a little bit more of an overview on Tshipi, our mine that we're invested in. As I said, great mine, very stable production, consistently a top 5 producing asset in the world. And you can see there on the top left-hand chart the comparison between the manganese price over that historical period of time and our cash cost, which has been very stable. Importantly, you can see a nice gap there. So through that cycle period of time, we have been, as I said, producing cash from Tshipi, paying dividends through Jupiter to our shareholders. Bottom left-hand corner, you can see called out in orange there, the mine life remaining for Tshipi, 121 years. So we don't spend any time or money at the moment anyway worrying about investing in exploration. We've got plenty of mine life remaining, notwithstanding the very significant production out of Tshipi. The team at site have done a great job on ESG, and that is part of our strategy as well, bringing that to light and further explaining what we intend to do in that area going forward. But as you can see there, relevant to a couple of metrics that are important for South Africa, mining charter and broad-based black empowerment score, the mine has continued to improve its performance over time, and it has an outstanding safety track record and community investment track record. So we're proud of that. And as I say, at Jupiter, that is part of our strategy, bringing that forward to explain to investors going forward. The chart on the bottom right-hand side there shows you that, not surprisingly, the mine's earnings track the manganese price. But as I said before, over that period of time where you can see some low manganese prices and some high manganese prices, the mine is still very profitable and cash generative because of its cost curve positioning. As a result of all of that, as I said, now looking at Jupiter's financials over that same period of time, Jupiter has performed well. It's a very profitable company, and you can see there charted on that chart there that we have paid, as I said, cumulatively 108% of our current market cap out to our shareholders in dividends in the last 5 years. notwithstanding, as I said, that we've got more than 100 years of that remaining. So we think that that underpins a very strong value proposition for Jupiter, certainly at current share prices. You can see there that Jupiter's average yield over that period of time since our IPO has been 13%, higher some years, lower others, but that tracks against an ASX average over that same period of time of 5.2%. So everyone likes our dividends, but talking to our shareholders since I joined 2 years ago, people would like to see dividends plus some growth because people can see off the strengths that we have and the starting position that we have, that there is a good opportunity to grow value through growth of the company whilst continuing to stream those dividends out from Tshipi and any other asset that we might own. Incidentally, the next dividend from Jupiter is due to be declared later this month. So that's our 5-year strategy. As I said, for the last 5 years, we have been paying out dividends on the basis that I showed you. And the first part of this strategy is to say that we intend to continue doing that. There's no reason why we shouldn't. Tshipi is well established. It's well exposed as a major player selling manganese into steel markets. But what we show here is how we intend to grow around that existing well-proven proposition. And there are 4 limbs. There's an efficiency limb, which is the first limb there, and that's really about continuing to focus on lowering operating cost and risk. Tshipi, within a South African context, is usually one of the more cost-efficient mines anyway, but obviously you want to continuously improve that. So there's a focus around logistics, which is an obvious one. Our mining is fairly straightforward. So our land logistics, our cost of moving ore from mine to port, usually make up about 30 to 35% of our costs, whereas mining is about 8 or 10%. So a lot of risk and opportunity in attacking that larger chunk of our cost of production. And we think there are good opportunities to do that. That's the major focus in the efficiency area. Industry leadership is about growing production both at Tshipi itself and also owned production within South Africa through targeted M&A. Tshipi produces, as you saw on the chart there, pretty much bang on 3.4 to 3.5 million tonnes of high-grade ore every year. We've got installed capacity to produce 4 million, so there's a relatively easy win there to incrementally increase production, given it doesn't require any enabling capital. We've never tested that, so there's a piece of work underway in exactly how that should occur and making sure it's sustainable in the pit. But we've got installed capital to do a bit more, so that's an easy part of that strategy. Sustainably Empowered is about really taking the good work that's already been done across the board from an ESG perspective and communicating that to Jupiter's shareholders. That good work has been happening on the ground since this mine started its operation in 2011, 2012. Jupiter's been listed since 2018. But shortly we'll be bringing out our inaugural sustainability report, which will describe what's there today, which we're all proud of, but also focusing on the work to be done over the coming 12 months as we seek to continuously improve in that area as well. Part of that will be putting solar in at Tshipi, which is a no-brainer, both financially and from an ESG perspective. So that's going to be one of the headline items within the within that sustainability report. The last part of this strategy we call upcycle. We're calling it that because we've already got a very good manganese mining business that's well established in its steel market. That part of our strategy is about leveraging those strengths and leveraging some of the byproduct production from Tshipi in order to upgrade that material into battery-grade manganese. So again, we've got an update coming out on that part of our strategy very shortly, but it's something we've been working on for about the last 18 months or so. It is a market which is not going to be high volume, compared to our 3.5 million tonnes of manganese ore production that comes out of Tshipi into the steel market every year. This will take about 100,000 tonnes of product that's already there on the stockpile, and that's one of our advantages in entering this space. But there are good opportunities through the value upgrade, through the processing that's required, and the pricing at the end of that through selling into battery-grade markets that really start to emerge in 3, 4, 5 years' time. So that's an additional piece of work. So overall, you've got efficiency in what we're doing currently and continuing to be focused on that off the back of a really good starting place from Tshipi's operations. Growing our business in a really targeted way. Firstly, at Tshipi, increasing organic production, but then looking at opportunities in a targeted way to acquire other production within South Africa. If you want to have a growth strategy around manganese ore, South Africa is the place to be, and this is where our existing business and partnerships are, and we're very familiar and comfortable with the growth strategy focused on South Africa for that reason. Wrapping the whole thing in the story of sustainability that's there today and is important increasingly to a number of our investors and customers. And a lot of that really, as I said, is just about describing the good work that's already been done and focusing on meaningful projects that have a financial case as well as a strong ESG case. And solar's the most obvious example of that. And then finally, continuing the work, and any investment here is a number of years away, to leverage our existing franchise relationships, capabilities and ore supply out of Tshipi to be a supplier into the coming battery manganese industry. So that's our growth strategy. We're underway on all elements of that strategy that was announced in March of last year, and you can see those 4 limbs that I pointed to a moment ago and some very high-level highlights for the sake of this presentation of work that we have been doing. We are coming out as we have something to say against that 5-year strategy from a progress perspective and providing specific updates. And in the very near term, we'll have updates on limbs 3 and 4 there, the sustainability report, which is due to be published this quarter from Jupiter. And also you can see there a picture of high purity manganese sulfate that we produced under our own process from Tshipi low-grade ore, and we provided a brief update on that late calendar year. And we've finished a full scoping study, a summary of which will be released to market very shortly. The other limbs we'll continue to provide updates on as well, but all limbs of this strategy are underway since we announced last year. Based on our dividend track record, as you can see there on the left-hand side, dividends that we have paid an average of 44 million Australian dollars per annum, sometimes lower, pending the manganese price, sometimes higher, but $44 million average over that period of time. And on the right-hand side, you can see the Jupiter share price that is implied if you work out any sort of trend towards ASX average yield. So the obvious point I'm trying to make there is Jupiter share price should be higher than it is today just off the dividend yield alone. The average ASX average for dividend yield is 5.2%. We've been paying at 12.8%. Somewhere in between those, we would hope to be able to, through better explaining of the existing story, but also the strategy that we're intending to pursue whilst continuing to pay dividends. We think the share price should be higher just off dividend yields alone. So the overall value proposition as we look forward, as I mentioned a number of times now, is that we are committed to continuing our current dividend payment policy. We have established a very good track record since Jupiter has been listed of paying out strong dividends. The policy is we pay at least 70% out to our shareholders of what we receive from Tshipi, and we have exceeded that threshold at every dividend since it's been established at listing in 2018. On top of that fact that even at the current dividend yield, without doing anything else, we think the price should be higher than it is today, and it's my job to explain the story so that we move that pricing in the right direction. We are in the areas that I've talked about pursuing growth that we think we're well positioned for. And so as we pursue that growth and as we bring it to bear over the next 5 years, we think there's good opportunity to grow capital value for our company and not just the overall share price. And then on the far right-hand side, there is manganese price upside that we are looking forward to. We are currently a little bit above 5-year low manganese prices. Again, because of our cost curve positioning, we're still producing good dividends at these levels, but now's a good time to invest. Manganese price is typically higher than it is today. It got down to about $2.66 per DMTU FOB in early December. It's now at about $2.93. The 5-year average is $3.54. An absolutely stupendous price would be $5.50. So there's a bit of upside there in the manganese price as well, and that obviously affects our revenue, dividends, and therefore share price. Thank Thanks everyone for your time. I hope that's been helpful.